When it comes to investing, it makes absolute sense to have a checklist. You want to process. The reason you want to process is because it saves you time, anxiety, removes stress, and it gives you something which is then replicable. You can repeat it, you can scale it, removes confusion. Whereas without a checklist, you're often flying by the seat of your pants. You're sort of taking an idea from here, idea from elsewhere, and your investments will be a mess. You'll end up with too many stocks in your portfolio. You won't know when a new idea comes along whether it's worth considering because you don't have a checklist against which to consider it. So you'll go onto social media, perhaps you'll find somebody talking about a company from one place to another, and you're risking your children's inheritance and your old age pension on such an approach, which is obviously highly risky. Instead, what I give my clients, what I suggest for them is, first of all, we work out their persona. And I categorize it into 4 different types of investing persona based on risk appetite, based on the amount of time they want to devote to a portfolio. You've got everybody from the busy surgeon who doesn't want to be spending too much time, so they want to look at their portfolio maybe once in 12 months and just check now and again to make sure nothing has hit any exits. And to the other end, the retiree who's got a lot of time, or the business owner who's retired, who says, well, actually, I want to spend a lot of time, this is what I want to be my new job. Once we've got the persona, we give them the data of 10,000 companies and 7,000 funds, which are exchange traded funds, so that they can then have ticked across for them which of those securities tick all the boxes of being undervalued, good average returns, low risk, low volatility, generating good yields in the case of many, high growth, box ticked as well. So all that hard work's done for them, and they've got the assurance that they've looked across 10,000. Now, if you don't have that as part of your selection, then again, you're flying by the seat of your pants. You're risking a lot by whichever approach you're using because you're not being thorough. The other aspect you can see over there is we allow room for the client themselves to then filter further if they wish beyond what we've done. As long as they're playing within the field of what we've suggested, if they then want to filter lower because they say, well, actually, my friend works in this industry, so I want to just pick the ones that you approve of, Alpesh, but also happen to be in this industry, that's perfectly fine. We finally give them a risk mitigation checklist. Now on this, we have some clients who are very risk averse, so we work out that they shouldn't have certain types of companies. And probably the most important thing they do at this stage, which is like the bespoke suit fitting for a security, is they look at the drawdowns, how much historically the volatility of the stock is, how much it's fallen, how quickly it's recovered, so that they're safe in the knowledge it's suited to them. Then, once they've bought, usually they're putting 2.5% to 5% into a security. In other words, roughly, they've got 20 to 40 securities. As a general rule, it depends on the particular individuals. We give them an Excel sheet on which to monitor this. We look over their shoulder to make sure their risk appetite, they told us, fits in with what they're actually doing. And then it's a simple question of monitoring. So relatively simple process, which once they get into the grip of it, it's a bit like learning to drive. You need to make your own process when it comes to investing. It needs to be at least semi-professional because it is, as I said, your children's inheritance. It's your old age pension. That's the reason why. I hope this was helpful. If so, do like and follow and share as well. Thank you very much.